Are you looking to buy one of these stocks? Let's talk about that. Hey guys, I'm the Newb investor. Today, we'll be looking at two staple companies, Coca-Cola and PepsiCo. I've seen a lot of YouTube videos always pairing these two up, and always comes a question of which is the better buy. Worry not, because we'll run them through my three metrics. Ticker symbol, KO, and PEP. KO is currently trading at 62.58 with high price of 62.82, market cap of 270.14 billion, PE ratio of 27.62, and EPS trailing 12 months of 2.26. It gives out an annual dividend of 1.68 per share with yield of 2.81% of the current price. PEP is currently trading at $167.71 with high price of 177.22. Market cap of 232.02 billion, PE ratio of 29.83, and EPS trailing 12 months of 5.49. It gives out an annual dividend of $4.3 per share with yield of 2.56% of the current price. If you're buying stocks for dividend, you might want to check out their payout ratio to see how much of what they're making are given out as dividends to its investors and how much money is left to them. First metric, we want an EPS multiple of less than 3. Why 3? It's just how I screen stocks mostly. I try to avoid buying stocks with EPS multiple greater than 3 because I don't want to overpay for an overpriced stock. Also, this metric tells me whether the company is buying back enough shares. We get the multiple by dividing the current PE by the EPS. KO is trading at 12.22 times earnings, and PEP is trading at 5.43 times earnings. Normally, I'd pass on this and move on to the next stocks. This tells us they're not buying back enough shares because they give out most of their money through dividends. Next metric, we want to pay $1 or less for 1% of the money they're making. Here, you'll see the revenue, cost of goods, operating expenses, net income, and free cash flow from 2017 to 2021. Below are its respective percentages relative to their revenues. Let's take a sample. KO spends 15.36 billion in COGS to make a revenue of 38.66 billion. That is 39.73% of the total revenue. You get the idea. Now, we take the current year's data and the averages of 5-10 years. Your preference. The more data, the better. In this video, I'll only be using 5 years of data, just to show my process. Take the lowest values of the numbers and use that to divide the current PE to see how much we're paying for every 1% of the money they're making. Why take the lowest values? Because we want to start our assumptions from there. For KO, 18.98 is the lowest value of the 4 highlighted ones. So, we use it to divide the current PE of 27.62 and we'd get 1.68, while PEP's is 3.39. This means we're paying more than what they're making when we buy the stock at these prices. Third and last metric is historical PE. We want to know our discount when we're buying the stock now compared to when the stock has traded before. You'd see the table here, the number of quarters I took the average PE from. I've included the highs and the lows as well. In this metric, we'll use the average PE to divide the current PE. For KO, we have 1.1. For PEP, 2.2. We're buying them at these multiples of how it was valued by the market before. To conclude, here are our 3 metrics. It's all red almost. This is overvalued, guys. People who are buying this are buying for the dividends, not really for the return. Here is my entry PEs. I've discounted them with my desired ROI and margin of safety. With PEP, that is still paying 2 times of what they're making at 14, 16, 18 PE. I think it's safe to say that you should pay premium for KO than PEP because they make the most of their revenues. For me, KO is the best buy comparing them by these 3 metrics. Would I buy any of them? No. They are just too expensive. Low EPS. I want them to cut the dividends and just buy back some shares. I bet most people would leave the stock if they decide to cut the dividends. If you want to invest in these companies, I'd advise you to use a higher time frame of data, like 10 years of data. Also, look at other metrics like long-term debt, current ratio, etc. As always, do your own research.